Welcome to our comprehensive guide on municipal bond financing, specifically tailored for nonprofit organizations seeking tax-exempt funding. In this video, we'll walk through the essential procedures, legal frameworks, and innovative strategies that empower nonprofits to access capital markets efficiently. Whether you're a board member, financial officer, or community leader, understanding the municipal bond process is crucial for sustainable growth and impactful service. Let's begin by exploring the foundational concepts and the regulatory environment that governs these unique financial instruments. The purpose of municipal bond financing for nonprofits is to provide access to tax-exempt capital, enabling organizations to fund projects that benefit communities. This guide outlines the scope of eligible projects, from educational facilities to community development initiatives. By leveraging the regulatory framework established by the Municipal Securities Rulemaking Board, MSRB, nonprofits can secure lower-cost funding and ensure compliance with federal, state, and international trust protocols. Understanding the scope helps organizations align their mission with sustainable financing solutions. Municipal bond issuance for nonprofits is grounded in the Internal Revenue Service Code, particularly Section 501(c)(3), which defines qualified charitable organizations. These entities benefit from tax-exempt status, allowing them to issue bonds with interest income exempt from federal taxation. The legal framework integrates federal statutes, state regulations, and international trust law, ensuring that projects in jurisdictions like Texas and Jamaica are fully compliant. This legal foundation is essential for maintaining the integrity and sustainability of nonprofit financing. Transparency is a cornerstone of municipal bond financing. Nonprofits must adhere to disclosure obligations set by the Securities and Exchange Commission and the MSRB. This includes providing timely, accurate information about the organization's financial condition, project details, and compliance with continuing disclosure requirements. Proper disclosure not only builds trust with investors and the public, but also ensures ongoing eligibility for tax-exempt status. Maintaining meticulous records and submitting required filings is a critical part of the process. Strict adherence to regulatory standards is non-negotiable in municipal bond financing. The MSRB sets forth rules such as G32, G34, and G17, which govern conduct, disclosure, and identification procedures. Nonprofits must ensure compliance with both federal and state regulations, as well as any applicable international protocols. This comprehensive approach mitigates risk, protects tax-exempt status, and fosters a culture of accountability within the organization. Regulatory adherence is the backbone of a successful bond program. Tax-exempt bonds are formal debt instruments that allow nonprofits to borrow funds at lower interest rates compared to traditional loans. The interest paid to investors is exempt from federal income tax, making these bonds attractive to a wide range of institutional investors. This structure provides nonprofits with reduced capital costs, extended repayment periods, and enhanced access to public capital markets. By leveraging tax-exempt bonds, organizations can align their long-term financial strategies with their mission-driven goals. Primary benefits of tax-exempt bond financing include a reduced cost of capital, extended amortization periods, and broader access to institutional investors. Nonprofits can secure funding at interest rates significantly below those of commercial loans, often saving 20% to 40% on borrowing costs. Additionally, the ability to repay over 15 to 30 years aligns debt service with long-term revenue stream. This approach empowers organizations to undertake ambitious projects without compromising their financial stability. While traditional wisdom cautions that the borrower is servant to the lender, the structure of tax-exempt bonds shifts this dynamic. By accessing capital through these instruments, nonprofits maintain organizational autonomy and uphold their foundational mission. The careful design of bond programs ensures that charitable organizations can grow and serve their communities without undue financial burden, preserving both independence and impact. Nonprofits cannot issue municipal bonds directly. Instead, a governmental entity known as a conduit issuer must formally execute the bond issuance on behalf of the nonprofit. In Texas, entities like the Industrial Development Corporation and Texas Public Finance Authority serve this role. In Jamaica, the Hanover Municipal Corporation and Ministry of Finance act as conduits. This structure ensures compliance with IRS regulations and preserves the tax-exempt status of the bonds, while the nonprofit assumes responsibility for repayment. Conduit issuer is responsible for the official issuance of bonds, but the nonprofit organization is ultimately liable for repayment. This arrangement allows nonprofits to access tax-exempt financing while maintaining the municipal status of the bonds. The conduit structure is essential for legal compliance and provides a clear pathway for nonprofits to undertake large-scale projects that benefit their communities. Initiate the bond issuance process. Nonprofits must establish an issuer account with the MSRB's Electronic Municipal Market Access (EMA) portal. This involves submitting official documentation including the organization's EIN and legal name for verification. Once approved, the MSRB assigns an issuer identification number, which is used for all future filings and disclosures. Accurate and current documentation is critical for successful registration and ongoing compliance. For incurring any project expenses, the nonprofit's board of directors must adopt a resolution of official intent. This resolution, in line with IRS regulations, declares the organization's plan to finance specific capital improvements through bond proceeds and authorizes reimbursement of eligible expenditures. The resolution must detail the project scope and grant authority for reimbursement of costs incurred up to 60 days prior to adoption. Resolution of official intent must clearly state the organization's intention to reimburse itself from future bond proceeds for initial project costs. It should include a comprehensive description of the capital improvements, authorization for reimbursement, and compliance with Treasury regulations. Properly structured resolutions ensure that all eligible expenses can be financed through the bond issuance, maximizing the organization's financial flexibility. Federal law requires public approval before issuing tax-exempt bonds. The Tax Equity and Fiscal Responsibility Act, TEFRA, mandates that a public notice be published and a hearing held to gather community input. Notices must be published in local newspapers or on official websites, and hearings provide an opportunity for stakeholders to comment on the proposed project. This process ensures transparency and public benefit. TEFRA process involves several key steps: publishing the public notice, conducting the hearing, recording comprehensive minutes, and submitting documentation to the EMA system. In Texas and Jamaica, additional state-level requirements must be met. Proper documentation and record-keeping are essential for regulatory compliance and for demonstrating the public benefit of the finance project. After bond issuance, nonprofits must file specific forms with federal and state authorities. In the U.S., IRS Form 8038 is required, while in Jamaica, the PBMA Form 3 and audited financial statements must be submitted. Registration with state bond review boards and verification of charitable status are also necessary. All filings must display the organization's EIN and MSRB issuer ID, and records must be retained for at least 6 years after bond maturity. Successful bond issuance requires assembling a qualified team, including underwriters, financial advisors, bond counsel, and trustees. Underwriters manage pricing and marketing, advisors provide impartial counsel, bond counsel ensures legal compliance, and trustees oversee the administration of bond proceeds. Each professional plays a vital role in structuring, executing, and monitoring the bond program, ensuring both regulatory compliance and project success. Only pre-qualified underwriters with demonstrated expertise in nonprofit and municipal finance are eligible to participate in the bond program. Selection criteria include MSRB registration, experience in tax-exempt bond issuances, and a strong track record in managing nonprofit portfolios. Engaging experienced underwriters ensures efficient execution and maximizes the financial benefits for the nonprofit organization. Bond issuance process involves several key steps: executing agreements, filing official statements with the MSRB EMA platform, settling issuance costs, and dispersing proceeds for approved expenditures. The closing process marks the culmination of months of preparation, with all parties executing final documents and transferring funds. The entire process typically takes 90 to 180 days from initial authorization to closing. For closing, legal opinions are issued, tax certificates are confirmed, and trustees establish account structures. After closing, all documents are filed with EMA, official statements are distributed, and project account monitoring begins. Quarterly compliance reports and annual disclosures are required to maintain transparency and regulatory compliance throughout the bond's life. Continuing disclosure is a legal obligation under MSRB and SEC rules. Issuers must provide annual financial statements, material event notices, and operating data updates via the EMA system. These disclosures protect investors, uphold market integrity, and demonstrate the issuer's sustained financial viability. Timely and accurate reporting is essential for maintaining trust and compliance. Issuers of tax-exempt bonds must fulfill ongoing federal reporting requirements to preserve the bond's tax advantage status. This includes annual disclosures of bond balances, use of proceeds, private business use monitoring, and arbitrage rebate calculations. Jamaican entities must also submit audited statements and performance reports. These measures ensure that bond proceeds are used for qualifying charitable purposes and maintain compliance with all regulatory mandates. All documentation related to bond issuances must be retained for at least 6 years after bond maturity. This includes official statements, financial records, audit materials, legal opinions, and compliance reports. Annual internal audits are conducted to verify the accuracy of EMA postings and ensure conformity with federal regulations. Proactive compliance reviews help identify and resolve potential issues before they escalate. Municipal bond financing is governed by a robust legal framework, including federal statutes, state laws, and international agreements. Key U.S. laws include the Internal Revenue Code and SEC rules, while Texas and Jamaica have specific statutes for bond issuance and oversight. Understanding these legal foundations is essential for structuring compliant and sustainable bond programs. MSRB establishes standards for fair dealing, disclosure, and fiduciary duty in municipal bond transactions. Rules such as G17, G32, G34, and G23 ensure that all parties act in the best interests of clients, provide timely official statements, and properly utilize CUSIP numbers. These safeguards protect investors and maintain the integrity of the municipal bond market. Accurate cost estimation is vital for successful bond financing. Issuance costs typically range from 2% to 3% of the bond's principal amount and include legal fees, underwriter discounts, trustee fees, and compliance monitoring. Annual and one-time expenditures must be carefully budgeted, with consideration given to fixed-fee arrangements to mitigate financial risk. Proper planning ensures that all project costs are covered and that the organization remains financially stable. Typical municipal bond transaction follows a structured timeline: feasibility assessment, documentation, public process, market engagement, and closing. Each phase involves specific tasks, from board authorization and team assembly to public hearings and investor presentations. Complex projects may require up to 12 months, but early engagement with experienced professionals can streamline the process and reduce delays. XONJX framework extends tax-exempt bond benefits to indigenous and land-dispossessed communities through innovative trust structures. By placing real property under qualified trusts, these communities can access development funding while preserving ownership rights. This approach supports education, agriculture, and renewable energy projects, ensuring sustainable development without unsustainable debt burden. Participation in the XONJX Tribal Trust ecosystem provides members with access to educational and charitable projects, community resources, and preferential bond offerings. The ecosystem is built on principles of generational wealth, educational focus, and tax-exempt status. Digital credentials and blockchain technology ensure transparency and verifiable membership, supporting long-term community prosperity. UPRTs are estate planning tools that allow grantors to transfer their residence into an irrevocable trust, retaining occupancy for a set term. After this period, the property is used for charitable purposes, such as housing missionaries or students. This structure provides favorable tax treatment and supports the organization's educational and charitable missions. Establishing a QPRT requires a professional appraisal, legal counsel to draft the trust agreement, deed execution, and timely gift tax filing. If the property is mortgaged, additional planning is necessary to avoid triggering due-on-sale clauses or unintended tax consequences. Ongoing compliance and meticulous record-keeping are essential for maintaining the trust's legal and tax status. XONJX program recognizes active participation through a tiered membership system. Silver and gold tiers offer increasing privileges, such as redemption rights, access to exclusive events, and eligibility for leadership roles. These incentives encourage ongoing engagement and support for the organization's mission, fostering a vibrant and committed community. Inflation Reduction Act enables nonprofits to monetize clean energy tax credits through the direct pay mechanism. Eligible entities can receive direct payments from the U.S. Treasury, equivalent to the value of qualifying tax credits. This innovation allows nonprofits to benefit from energy investments, such as solar and electric vehicles, even though they are tax-exempt. Claim direct pay credits. Nonprofits must register with the IRS, compile project documentation, and submit the appropriate tax forms. The process includes online pre-registration, submission of Form 990T, and supporting documentation for each qualifying property. Payments are typically issued within 180 days of a complete submission, providing valuable cash flow for eligible projects. Combining tax-exempt bond financing with elective payment credits maximizes available capital and reduces long-term debt service. The process involves issuing bonds, constructing the project, claiming energy credits, and applying payments to reduce outstanding principal. This integrated approach enhances financial leverage and supports the expansion of nonprofit initiatives. Agrivoltaic development integrates agriculture and solar energy on the same land, generating multiple revenue streams and advancing sustainability. These projects qualify for tax-exempt bond financing and direct pay credits. Benefits include enhanced land productivity, educational opportunities, and improved water conservation, making them ideal for nonprofit initiatives focused on environmental stewardship. XONJX XIIIth cargo vessel, known as the Antidote Lost in Paradise, serves as a mobile educational campus, agricultural transport facility, and renewable energy platform. It supports international exchange, emergency relief, and cultural preservation. The vessel's onboard infrastructure includes classrooms, agronomic systems, renewable energy, and residential accommodations for students. Vessel qualifies for tax-exempt financing as educational property. Bond proceeds are allocated for acquisition, retrofitting, technology operating reserves, and issuance costs. Security provisions include collateralization, revenue pledges, and insurance. At least 95% of operational time must be dedicated to educational purposes, with strict compliance monitoring and annual reporting. Nonprofits can finance clinical research and agricultural facilities through tax-exempt bonds, provided they align with educational missions. These projects involve research, cultivation, quality assurance, and educational initiatives. Partnerships with accredited universities and systematic impact measurement ensure that research benefits both students and the broader community. XONJX framework incorporates blockchain technology for transparency and immutable record-keeping. All transactions are recorded on the compliance chain, and student achievements are verified through NFTs. Real-time auditing and smart contract automation ensure that funds are used solely for approved purposes, enhancing accountability and trust. XONJX ecosystem uses dual tokens, TTG utility credits and TTGS share NFT rewards. These tokens provide membership benefits, program utility, and governance rights while adhering to securities regulations and nonprofit standards. The system is designed for educational use, not as legal tender, and supports the organization's mission through innovative digital tools. Artificial intelligence trade agents automate compliance workflows, document generation, and risk assessment. These intelligent systems monitor bond covenants, reporting deadlines, and regulatory requirements across multiple jurisdictions. By leveraging AI, nonprofits can reduce administrative burdens and ensure consistent adherence to all mandates. Avatar Interface System assigns specialized AI agents to manage financial, operational, and programmatic aspects of the bond program. Each avatar is responsible for continuous monitoring and support, ensuring that established policies are consistently applied across all transactions. This system enhances efficiency and oversight in complex financial operations. Comprehensive insurance coverage is mandatory for all bond finance facilities. This includes general liability, property, directors and officers, professional liability, cybersecurity, and reinsurance. Insurance certificates must name the bond trustee as an additional insured and be renewed annually. Proper risk management protects both the organization and its stakeholders. XONJX model integrates compliance requirements from both the United States and Jamaica. This includes maintaining tax-exempt status, fulfilling disclosure obligations, and adhering to charitable registration and reporting mandates. Cross-border coordination ensures that all legal and regulatory standards are met, regardless of project location. XONJX framework aligns with the United Nations Declaration on the Rights of Indigenous Peoples, UNDRIP, ensuring self-determination, educational autonomy, land rights, and meaningful consultation. This commitment empowers indigenous communities to participate in modern financial systems while preserving their cultural heritage and governance structures. XONJX Bond Program adopts the World Bank Environmental and Social Framework, ESF, committing to sustainable development, fair labor practices, resource efficiency, and community engagement. Regular assessments and stakeholder consultations ensure that projects deliver verifiable benefits and uphold the highest standards of environmental and social responsibility. XONJX framework incorporates service-disabled veteran-owned small business (SDVOSB) joint ventures, enabling eligibility for federal contracts and workforce development programs. This integration supports veteran entrepreneurs, sustainable agriculture, and renewable energy initiatives, while maintaining the nonprofit's mission and compliance with federal regulations. Bond program is structured for phased implementation, with quarterly tranches allocated to discrete franchisor units. This approach facilitates continuous quality improvement, prudent growth management, and transparent reporting. Each tranche is tied to specific project milestones, ensuring accountability and flexibility in adapting to market conditions. PAC measurement is integral to the XONJX bond program. Metrics include educational program participation, renewable energy generation, community development hubs, and scholarship allocations. Environmental, social, and governance (ESG) performance is tracked through employment creation, carbon reduction, and stakeholder satisfaction. Annual impact reports are filed with EMA and shared with bondholders. Bondholder protections include clear definitions of default, cure periods, acceleration rights, and security enforcement. Disputes are resolved through direct communication, arbitration for smaller claims, and legal remedies as needed. This framework minimizes the need for formal enforcement actions and maintains strong relationships between issuers and investors. Provisions for mergers, consolidations, or asset transfers require advance notification, tax opinions, and successor entity assumption of obligations. Rating agency affirmation and EMA disclosure are also mandated. These measures protect bondholders and preserve the tax-exempt status of the bonds during organizational changes. Bond redemption provisions allow issuers to refinance or retire debt early under specified conditions. Non-call periods, premium redemption windows, and mandatory redemption events are clearly defined. These options provide financial flexibility while protecting bondholder interests and ensuring compliance with governing documents. Maintaining tax-exempt status requires continuous oversight of arbitrage, private use limitations, and expenditure regulations. At least 85% of construction funds must be spent within 3 years, and private business use must remain below 5%. Comprehensive documentation and annual evaluations are essential for ongoing compliance. Property financed by tax-exempt bonds undergoes a change in use. Remedial actions must be taken to protect tax-exempt status. Options include redeeming bonds, establishing escrow, or converting to an equivalent public use. Immediate consultation with bond counsel is advised to maximize available remedies and maintain compliance. Refunding outstanding bonds can achieve economic efficiencies or enhance operational flexibility. Current refunding occurs within 90 days of redemption, while advance refunding is now limited to taxable transactions. A net present value savings threshold of 3% to 5% is generally required for financial efficacy. Common pitfalls in bond financing include insufficient planning, inadequate record maintenance, and covenant noncompliance. Best practices involve engaging professional counsel early, developing internal capacity, implementing robust systems, and maintaining proactive communication with stakeholders. These strategies ensure optimal outcomes and regulatory compliance. XONJX XIIIth Grade curriculum integrates bond financing education for board members, staff, and students. Training covers fiduciary duties, compliance, risk management, and the use of technology in finance. Community education promotes transparency and accountability, empowering all stakeholders to participate effectively in the bond process. Clarifications include the typical duration of the bond issuance process, eligibility of expenses, collateral requirements, and access for international nonprofits. Operating expenses are not eligible for bond financing, and alternative revenue streams or credit enhancements may be used in the absence of real property collateral. International nonprofits can participate through partnerships and conduit structures. Sandy Bay Educational Campus in Jamaica exemplifies the bond financing process from conceptualization to post-implementation. The project included modern classrooms, agrivoltaic farms, and advanced labs, funded by a blend of tax-exempt bonds, direct pay credits, and grants. 3 years after opening, the campus boasts high enrollment, renewable energy generation, job creation, and scholarship disbursement, with full regulatory compliance. For further information or assistance, the XONJX World Mission Main Office provides comprehensive support. Key contacts include the Executive Trustee, Commissioner, and Chief Development Finance Officer. Office hours, emergency hotlines, and official email addresses are available to ensure prompt and effective communication for all stakeholders. Wealth of additional resources is available, including IRS publications, MSRB EMA portal, Texas Bond Review Board, and professional development curricula. Endorsed scholarly texts and regulatory guides provide further insights into municipal finance, compliance, and best practices. These resources support ongoing education and professional growth for all involved in nonprofit bond financing. Tax-exempt bond financing is more than a funding tool. It's a covenant between organizations and the communities they serve. By upholding transparency, accountability, and measurable impact, nonprofits can transform visions into reality. The XONJX XIIIth Grade framework demonstrates how modern technology, indigenous rights, and faith-based stewardship can enhance traditional municipal finance for lasting community benefit.